Financial topics, trending news, politics, all come together here at the Vault.
All right, so Charles, tell me why we're here.
Yeah, so I actually got to do a speaking engagement in the next probably hour or so. Okay. So obviously it's a beautiful day outside. I figured we could shoot down here this week.
What are you speaking about?
Well, just doing a little bit of financial literacy. Obviously, education's always at the top of the forefront of my mind. I want to make sure that I do my best to educate those around me.
Expecting a big crowd?
I don't know, we'll see. Sometimes you never know with these things. Somebody else put the event on, they just invited me to speak, so sometimes I never know.
Okay, yeah. Okay. Yeah. But you're just gonna provide value?
Just going to provide some value, that's it.
All right, well tell me about, obviously the market has been all kinds of wonky.
Yeah.
What do you think? Is the worst past us, or what do you think?
Yeah, it looks like to me like the market actually peaked in June, and ever since then we just kind of been teetering between stories. So obviously you got a bunch of different risks in the market right now. You got interest rate risk, you got the fact that the Federal Reserve is possibly getting out of the market, right? Okay. I'm not so sure they're actually going to do that, but that's also one of the risks. Then you also got to deal with the simple fact that Russia could be invading Ukraine. Right. That's another story right now. An additional story on top of that is the fact that rates are rising, and then last but not least, you got inflation. So that's hotter than ever over the last 40 years. So, there's a lot of different stories right now that are making, there's too much convoluted noise right now, and very few people are concentrating on exactly what's going on in the aggregate. The oil markets right now are going a little bit crazy right now. Obviously, we just talked about inflation, correct? So I still think oil is going to continue to be elevated for the simple fact that we've never had a situation for closing down global markets. Right. So there's this is like a whole new playbook that just started, right? But the good thing is these are opportunities that you can learn from, right? So the one thing that the reason why I believe that oil will continue to be elevated is because, again, everything was shut down. So if you think about this for a second, if you know as a business owner that there's a ton of demand for a particular product or service that you provide, well, what are you going to do?
Yeah, of course.
You're going to raise prices. Yeah. So that's exactly what happened. And I think a big reason why oil prices continue to go higher, Vladimir Putin knows and understands that 36% of his overall revenue to his budget is based off of oil prices. Right. So if in 2020 he wasn't expecting the oil price to jump and it did, well, let's make it go a little bit higher, right? Because obviously we can't starve our economy. We need oil prices to be higher. So I don't know whether or not this whole Ukraine thing is somewhat of a ruse or not, but I mean, it seems completely plausible that the more troops you put near the border, the higher the oil price goes, it helps you. Yeah, now, the next phase is if he wants it to go even higher, what do? Maybe you go into the country, right? So these are just some things that I believe that are some of the reasons why we're starting to see this elevated volatility in the oil markets, and why it'll continue to stay there is because people want to travel. Right. When you come to the streets down here to Sarasota, you come down here on a Saturday evening or a Friday evening, streets are packed. Yeah, right? Yeah. So people want to get the hell out of the house and they want to travel, right? So with that being said, oil demand is going to continue to be high because people want to go places, right? Around. So that's why I believe oil will continue to stay elevated for the time being. Now, with regards to the Federal Reserve, first and foremost, let me kind of explain quantitative easing. Okay. Quantitative easing is a monetary policy in which the Federal Reserve buys long-term securities from the Treasury. So do you know or understand how bonds work?
Only from what you've told me, only a tiny bit.
So for those of you who don't know, the way a bond or fixed income asset works is if you ever walked into a courtroom and seen the scales of justice. Yeah. Okay. So picture on one side, you got bond prices, and on the other side, you got coupons or bond interest, right? Yeah. So obviously, it's going to teeter a bit, right? But what the Federal Reserve does, it buys fixed income security. So if it's buying, it's going to raise the price on one side. So what do you think happens on the other? It's going to go down. Right. So what happens when they do the reverse, right? Yields will go higher. So what's happening now, they're talking about doing quantitative tightening. And basically what that means is they're taking money out of the economy. Okay, so therefore, the crack that we've all been hooked on so much, because most people don't even realize the Federal Reserve balance sheet is about $9 trillion right now. And when we first started back in the crisis back in 2007, 2009, the Federal Reserve's balance sheet was right around 700 billion, right? And now it's at 9 trillion. So but yeah, I mean, a lot of people look at it as a bad thing because that's also contributed a lot to the debt. However, one of the things they don't understand is the stock market since then is up more than 400%, right? The housing prices have more than doubled. And there are some actual ancillary benefits to this, you know what I mean? Yeah, so sure. It's just one of those things where, you just got to stay patient, and time in the market is the only benefit. One of those other, hey, what's up, buddy? How are you?
All right.
This young man is Dennis Ford. He is one of the only young black business owners on Main Street here in Sarasota. He runs Mankind Barber Lounge. And not only does he work with young men in the area, but he also works with young ladies as well. They have a stylist who can work with females as well. So please do me a favor and come down and see my buddy Hootie.
Yeah.
Appreciate you. Good guy. Kind of a staple down here in Sarasota. Kind of everybody knows him. Yeah. They were some of the first people that I met here in Sarasota. But good people, good business owners.
Hey, well, hold on, Charles. I'm gonna stop you for a minute because a few minutes ago you said something I didn't understand. Quantitative tightening.
Yeah. So quantitative tightening is basically the reverse of quantitative easing. When the Federal Reserve is easing or putting money into the economy, that means they're buying fixed income securities, most likely mortgage-backed securities, on the open market. Okay. And like I said, when they buy, that raises the prices of these fixed income securities, and therefore puts more money into the bank's pockets so they can lend to people in the economy, which also, grows the economy. Right. So when they do quantitative tightening, it's basically the same thing, except they're doing the reverse. They're selling bonds as opposed to buying them. Okay. So when they sell them, obviously somebody else has to take that risk on, right? So, and what that does is it actually takes money out of the circulation, out of the money supply, right? So for instance, companies that were trading at very, very high multiples, so stocks like high-flying tech stocks, some of those meme stocks, right? People were willing to invest in those because the cost of capital for those particular companies was very, very low, right?
Low risk.
Exactly. So you can afford to wait for some of their earnings that may or may not come in the future, right? If interest rates starts to rise, that means their cost of capital goes up. That means their margins get squeezed. So you actually need companies to perform better today rather than sometime in the future. So that's a big reason why quantitative tightening is also affecting the market right now.
Gotcha. That makes sense. So I shouldn't buy meme stocks.
Damn sure don't do that. Please don't. Yeah, so meme stocks, they were fun for a minute, but the other thing that people don't really realize is there's the whole meme craze introduced 23 million new people to the stock market.
Right, yeah. Right? People are interested in it.
Right. Yeah. And the big reason why a lot of these people are in and out of the market is because they didn't have a lot in the market to begin with, right? These are accounts that are less than $5,000. Right. So, a lot of these people don't know and understand exactly what value is or how to even find it, right? So they just knew that everything was going up, so they just wanted to be a part of it. Yeah. Fear of missing out. FOMO, yeah. There you go. So, it's just one of those situations where things got a little bit out of control. And now things are starting to get back to where they used to be. Yeah. So now we're starting to see some of the same old stories start to rear their heads. Gotcha. So that's why people are buying more industrial stocks, more financial stocks.
The classics.
Right, because those stocks normally do better in a rising interest rate environment.